5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to the only radio broadcast dedicated to bringing you more truth packed into 1 hour. When the mainstream media gives you all week long, you have found it. You're listening to Follow the Money Weekly Radio on the web at www.ftmdaily.com. That's followthemoneydaily.com. Well, we have a great program lined up for you this week. We're going to be giving you kind of a little sampling of a few things. First of all, we're going to be joined by Tom Cloud. He's going to be here providing us an update on precious metals and what's been happening in the economy. We'll be following that with a kind of a neat little appetizer for those of you who are not currently a part of our FTM Insider program. It's $9.95 every single month. Well, what we're going to give you is a little taste of what it's like to be an insider. We're going to share with you a little clip from last Wednesday's conference call. Every Wednesday at noon Central Time, all of our FTM insiders are able to dial into a special phone number and participate in a weekly conference call. Sometimes it'll be me just providing an economic update. At other times, I'll be joined by well-known guests. This week, I was joined by John Rubino from DollarCollapse.com. He's a best-selling author with James Turk on a book. We just talked about the economy, and we shared with the audience, and then we took audience questions. We won't play you the whole thing. I'll just play you a little snippet of it. But you're able to hear kind of what happens, and obviously people can call in and ask questions, make comments, so it's really great for a community. Wanted you to kind of get a sample of that, especially those of you who are not currently FTM insiders. We also have an interview with Dr. Paul Cleveland. He is an Austrian economist, and he has written a couple of books. He teaches on staff down in Alabama at a university down there. And he'll be on the program to talk a little bit about Austrian economics, the difference between it and Keynesian economics, and just quite a few other things as well that he'll be sharing. Also, as always, we're joined by Jay Peroni with his investing idea of the week and John Burrs with his retirement minute. But let's just go ahead and get started. I want to bring on Tom Cloud right now. Let's head into our precious metals market update.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Well, Jerry, there are two main concerns and things our clients have to watch between now and the end of March. Number one is the situation in Cyprus, because the Russians' money has been taken and ordered by the IMF. And for the one listeners that don't know, we control 51% of the IMF, so it's basically the United States saying take the Russians' money, and that is not going to happen. And it's going to tell you the Russians are not going to give up their money because they have hundreds and hundreds of millions of dollars on deposit in Cyprus, and this could turn into something big for gold, or it may just ease over it. But remember, next week on Wednesday, the 27th, is when the debt ceiling has to be raised or the government has to shut down. And certainly we know the government's not going to shut down. If they raise the debt ceiling $2 trillion, they raised it $1.2 trillion in August 2011. If they raise it $2 trillion, the dollar will start falling in the world market, even with everything else going on. But the other thing, we're now seeing sell signals coming out from people like the Aiden sisters that are saying the bond market is topping. And once that bond market, which is the backbone of the world economy, starts dropping, money will exit, and a small percentage of it will move to gold, and this will be very beneficial. So we've been through, nearly 3 months, and gold is down 3.5% for this year, and silver is down about the same. But we think all that is in the turning mode here in the next few days, and your clients and our listeners can expect to see this happen and see gold once it breaks 1620, we're only $6 or $7 away from that. It should take off to 1660 before it has any resistance, and then back above 1700. So it's a great time to be moving into the metals. Silver, while also should do exactly the same thing gold is doing, it does need to close above 29.50 to give an all-out buy signal. We're only about 30 cents away from that. And platinum and palladium are just in incredible short supply. The Russians are saying they don't have the supply that the world needs. We've seen some $25 up days in platinum and 17 in palladium this week. And those two metals, if you believe we're not going to have a world recession because of quantitative easing, you need to take a position in platinum and or palladium. Both of them, or pick one of them at least, because both of them look like for the second straight year they could be the top two performing metals. Last year, platinum was number one and palladium was number two, silver 3, and gold 4. And while there weren't huge differences, I think we'll have another year this year where platinum and palladium. And the shortage in platinum is unbelievable when you talk to major wholesalers and suppliers. And platinum bars and maple leafs that still have a reasonable commission, but platinum eagles have gone to an 11% premium from 8% this year in only 3 months. So, but I would still buy the maple leafs or the bars. They're a much better value. So next week, Jerry, we can do a full-blown interview and do a catch-up on everything after we see what happens with the debt ceiling and get an update on Cyprus and President Obama's trip to the Mideast. And, Jerry, if anybody wants to call me, they can reach me at 800-247-2812. That's 800-247-2812. If you're not on our email blast, getting buy and sell signals and economic updates, you can go to FTM Daily, hit the Precious Metals button, and sign up for our blast that goes out 2 or 3 days a week, and that is completely confidential. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years' experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Welcome back to Follow the Money Weekly Radio on the web at ftmdaily.com. You can always call us 800-609-5530 with your financial questions, your comments, or if you'd like to purchase one of our books or products or whatever the case might be. We are here to answer your call, 800-609-5530. Also, if you have a question for us that you'd like to have aired on the program and answered on the program, when you call 800-609-5530, instead of pressing option 1 to come through to the customer service area, press option 3, and that'll take you to our question line. When you press 3, you'll be able to go there and record your question, and be sure to leave your name and town so that we can properly address you on the show. So we have had, I don't know how many new FTM insiders over the course of the last 3 months, and I think a lot of it has to do with the popularity of our book, Bankruptcy of Our Nation. As people are reading it, they're realizing they need to do something, and they're becoming FTM insiders. And our insider program is $9.95 per month or $99 per year. To me, it's one of the best deals out there. I've seen a lot of different subscription services out there, have seen many different newsletters out there, and, not putting any of those down by any stretch of the imagination. But I will tell you that we have worked very, very hard to make sure that we are providing a tremendous amount of value for the very small amount of money that we charge for our service. And I wanted to give you just kind of a taste of what our insiders receive. This is just one of the many different benefits that they receive, and that is a weekly conference call that's live that they can actually attend by phone, and then they can also ask questions and make comments. And so I wanted you to be able to hear this so you knew exactly what was part of the FTM Insider program. I think this is just a great benefit. So we're going to play a little clip here of myself and John Rubino. Next week, by the way, we're going to have Tom Cloud on the conference call for those of you who want to ask questions and maybe talk to him about something. All of you FTM Insiders, be sure to attend our conference call next Wednesday at noon. And, of course, the phone number, the special phone number and access code are inside the membership area only. If you'd like to become an FTM Insider, you can call us 800-609-5530, or you can always do so right there on our website. But now let's go ahead and head over to our little snippet of our weekly conference call this week. And our guest was John Rubino from dollarcollapse.com.
Folks who are joining us today, I want you to know that you can join in the conversation if you'd like to. We typically will talk for a little bit, banter a little bit, and then we will open it up to any questions you have about either A, anything that you've heard said, or B, if you just want to ask a question about something unrelated even. We're open to that as well. I want to jump in quickly and talk about what's happened in Cyprus. John, the EU, it looks like Cyprus is going to be able to wiggle its way out of the bank confiscation, the money confiscation, it looks like, the last thing I saw at least. What were your thoughts on that? Do you have any concerns that's going to spread? Do you think that's just kind of an isolated geopolitical event? What do you think's going on there?
Well, when I watch this stuff, I'm struck by the fact that the U.S. actually seems relatively well run now compared to Europe and Japan and several other places. But the Cyprus thing in particular is potentially really serious because up until this point, the Eurozone has bailed out its banks, and so has the U.S., for that matter, by taking money from taxpayers, in effect, printing new currency and giving it to the banks, which diminishes the value of our savings. So it's an indirect tax on society as a whole. What Cyprus has done this time is make it explicit. They've taken money directly out of bank accounts, or tried to take money directly out of bank accounts, in order to fund the bailouts of the bankers. So the guys running the big banks in that country can go on earning millions of euros a year and paying themselves big bonuses and reaping the rewards of their position in a finance-dominated society. And the reason this is important is because it gets the attention of basically everybody with a bank account. For instance, if you're in Italy right now and you're watching this and you've got an account in an Italian bank, you'd be crazy to leave that money there. So what you're probably going to do is go to your ATM or go directly to the bank and take out as much money as you can and put it in some place that isn't taxed directly or confiscated directly by the government next time there is a crisis. And so this has the potential to cause a bank run all across the peripheral part of Europe. You could see Spain and Ireland and Portugal and Italy all seeing the same thing happen. And if that happened, it would pull down the banking system in not just the periphery, but all of Europe, because the Italian banks, for instance, owe a ton of money to the French banks or the German banks. So let the Italian banks get hit by major bank runs, and that directly impacts the big banks in the supposedly safe, stable part of Europe. So you could see this spread in a hurry. That's why everybody's paying so much attention to it. Cyprus itself is smaller than Greece. It's not really much more than a rounding error in terms of the Eurozone economy, but its impact could be far out of proportion to the size of the country.
One of the big questions we get here quite a bit, John, you probably heard the same thing, especially writing a book about why you should buy gold and silver, why the economy is in turmoil, and why it's going to continue to be that way. Many people are, knocking on the door, sending emails, and saying, hey, the market's going up, the dollar is going up, relatively speaking, to other currencies right now, especially with the euro and the yen. And everything I'm hearing on the news says that it's all going to be fine. It seems like we're working our way out of the woods. We've got the market back to all-time highs. What's wrong with the picture? What are people not seeing in the mainstream press right now?
Well, first of all, using the stock market as an indicator of the future is a flawed analytical technique. Because if you look at the last two times the stock market was at this level, it was early 2000, before the tech bubble burst, and we went into a really deep, hard recession. And then in 2007, before the housing bubble burst, and we went into the Great Recession. So the stock market hitting new highs is actually a contrary indicator. It means that a ton of money have flown into risky assets. The system has gotten fragile, and it's towards the end of whatever cycle caused the stock market to go up. So that's probably true here, too, because what's happened is the Federal Reserve in the U.S. and the European Central Bank and the Japan Central Bank have all been pumping out huge amounts of new currency, and some of that has flown into the stock market, and which has pushed up stock prices, but at the cost of huge amounts of new debt taken on in the system and huge amounts of new currency sloshing around out there and making each individual piece of currency less valuable. So we're making the system more and more fragile. The fact that the stock market is up right now is a symptom of that fragility rather than a sign that good times are here again. So unless the underlying stuff gets fixed, then these macro numbers like unemployment and consumer price index and the stock market, they don't really mean anything. The important stuff is going on below the surface, and that is how much debt we're taking on, how much currency we're creating, and how fragile in general the system is becoming. And all of that is getting worse year after year, week after week. So we're really creating the conditions in which something big and serious and bad will happen pretty soon. And, it might come back to Cyprus as the catalyst, or it might be any number of other things. All kinds of things can happen that would sap the confidence of the market and send these macro numbers in the wrong direction, or really back to where they should be, to put it more honestly. So we're at the point now where it's just a catalyst watch. What's going to be the thing that scares everybody and changes everybody's mindset and makes stocks go down or bonds go down or gold and silver go up, or all of the things that should be happening in this kind of a macro environment.
Yeah, and everything's become so distorted because of all the money that's flowing in. I mean, the stock market and the dollar both going up is somewhat, that's odd and bizarre. And all the fundamentals that are underlying all of this whole mess, I mean, they haven't changed at all. In fact, they've only gotten worse. Nothing's really improved here in the United States, has it? I mean, unless I missed a headline, I don't think that anything has changed. In fact, it's only become worse. Don't you agree?
Well, in the sense that debt keeps going up. What happened in the fourth quarter of last year is that, we had been deleveraging slightly. The private sector had been paying off debt in the U.S. at a slightly faster rate than the federal government was taking on new debt. And so the total amount of debt in the system was actually going down just a little bit. Not enough to save us, but it was trending in the right direction. But in the fourth quarter of last year, that changed. The private sector started borrowing more money again. We started taking on new mortgages, and student loan debt kept on soaring. And so now the total debt in the U.S. system is going up again, which is really the only fundamental underlying thing that we need to know. If we're taking on more debt when we're already more indebted than we've ever been in human history, really, no country has ever owed this much money before. And if you calculate that correctly, it already comes to about $2 million per family of four in the U.S. So for us to be borrowing more money at this point is exactly the same thing as the family down the street that already owes a ton of money on a big house and an SUV and big screen TVs and nice vacations, maxing out more credit cards.
Yeah, hearing that they got a brand new car or something,
Yeah, exactly. And so that won't end well. And they're making a mistake, even while they're living on the surface very well. They look rich if you didn't know their balance sheet. And we're exactly like that. You still see politicians saying, oh, yeah, in the richest country in the world, we should be able to, and then fill in the blank for your favorite program. But
unfortunately.
Yeah, but that means they're not looking at the balance sheet. They see what we have in physical terms, but they don't see what we owe in financial terms. And you can't understand someone's situation unless you know what they had to pay in order to get what they have. And the U.S. has had to pay more and more each year to stay in the same place. And this is the kind of thing that's completely unsustainable. We saw that in 2009. We had a near-death experience there. If we hadn't created another $10 trillion and tossed it out into the market, the U.S. financial system would have collapsed and pulled down the rest of the global financial system with it. And we didn't fix anything in the meantime. All we did was, in effect, max out a couple more credit cards in order to keep our kids in private school and keep the SUV gas tank filled and keep current on the mortgage. That's all we did. And now we've got this new debt that we've got to deal with. So that's where we are. And these nice macro numbers are masking that in the short run, but they won't mask it forever because the fundamentals always win out in the end.
The Federal Reserve seems to confirm your thesis because they are intent on continuing the stimulus. They're going to continue their $85 billion monthly purchases of treasuries and mortgage-backed securities. So,
Jerry, it's important to understand why they can't stop. Because if they did, see, they're the main buyers of treasury bonds right now. And if they stopped, that means the government would have to find other buyers for its bonds, and it would probably have to pay a higher interest rate. And that higher interest rate would add directly to the deficit because our interest costs would go up. And so our borrowing needs would go up while our interest rates were going up, and that would create really a death spiral for U.S. government finances because the more we have to borrow, the higher our interest rate goes, and the higher our interest rate or our expense goes, then the more we have to borrow. And we can't let that process start because it would end with a complete collapse of the U.S. financial system. So the Fed is stuck buying up most of the bonds that the government creates when it borrows money, and there's no end in sight to that, which means there's no end in sight to the trillion or so new dollars a year that we're going to have to create going forward.
Have you been paying attention at all to the Bank of Japan, or have you been kind of paying attention to what's going on in Japan with the new Shinzo Abe leadership? Do you have any comments on anything in Japan right now?
Oh, yeah, Japan is potentially huge because they're in financially worse shape than the U.S., and demographically they're a disaster waiting to happen. They've got an aging population where retirees are going to outnumber workers at some point in the not-too-distant future. And meanwhile, they already owe more money as a percent of GDP at the government level than the U.S. does. And their deficits are huge. So Shinzo Abe, new leader of Japan, came in and basically threatened to take over the Central Bank of Japan unless the central bank agreed to set an inflation target of 2%, which means they've got to create huge numbers of new yen in order to get the inflation rate up to even 2% because they've had deflation for the last couple of decades because they borrowed so much money in the 1990s and they've been unable to get out from under all this debt. So that means that Japan is going to be aggressively trying to lower the value of the yen, which causes trade problems for the U.S. and Europe, which is basically the currency war that I'm sure you've talked about frequently, and I'm sure your listeners understand pretty well right now, where all the major countries of the world are aggressively trying to lower the value of their currencies to gain trade advantages versus each other. And that's a zero-sum game because if everybody's doing it, nobody gains any real advantage, and you just have a swing of a pendulum back and forth between one currency going down and the economy benefiting from it, but the people who are hurt by it lower their currency, and then they benefit briefly until you get a global death spiral in paper currencies. That's where we're headed. And Japan is a crucial part of that process because they're a big economy in dire financial straits with really no choice from their point of view but to depreciate their currency really aggressively. So they might be the main driver of the global currency war over the next few years, but the U.S. and Europe are both active participants because we have big problems too, and everybody knows what our problems are, and it's kind of common knowledge now that our only solution is a weaker currency. And so that's going to be the main story, assuming nothing else major happens to just stop this process in its tracks, which is also possible in the short run. It's really about catalysts. It's really about what pushes us off the cliff. Either we drift for a few more years with the currency war swinging back and forth between different countries and gold and silver going up incrementally year after year, or something big happens to just shock the financial system into a new state where, like in 2009, everything falls apart almost, and we have to reevaluate all our basic premises. That day is coming too. Eventually we're going to decide that paper currencies under the control of governments is a huge mistake because it corrupts the people that have this basically unlimited credit card and turns all of our governments into monsters, and that's what's happening now. And eventually we're going to see that, and we're going to lose faith in the whole concept of paper currency. Again, that it's coming. We can't know when, but something like that is out there waiting to happen.
Yeah, and the Bank of Japan has a new leader, Kuroda, and from what I've been reading about him, he's extremely aggressive, and he's even talking about buying derivatives as asset purchases. And, of course, Shinzo Abe is also very aggressive. I mean, many people who have studied history know that in the post-World War II era, Japan was defanged. They had a constitution that was imposed upon them. They had to keep a very small military in the post-World War II era. And Shinzo Abe is flaunting his power in saying, look, we're going to militarize, we are going to debauch our currency, we are going to go a very different direction than we've been going for the last 2 or 3 decades. So Japan really could be a game changer. What about the Bitcoin? You ever study that at all? You ever talk about the Bitcoin? You ever bought any?
Well, I had a techie friend the other day try to explain Bitcoins to me, and
the same way.
I never got past the point of wondering what the government will do when Bitcoins becomes perceived as a threat to the dollar, because Bitcoins is basically a cyber currency. It exists online, and the creation of it is beyond the control of any one government or any government. And because of that, it's become very popular, and it's beginning to look like a potential threat to some of the governments out there. But what's to stop our cyber war guys, the part of the Defense Department that are now charged with, protecting us against China and then shutting down, Chinese banks and things like that, and Russian banks when the time comes. When we get into a battle that involves cyber warfare, we have the capabilities now. What's to stop them from turning their attention to Bitcoins and trying to shut it down? Now, my friend tried to explain to me why that's impossible, and I didn't understand the explanation. So that's as far as my expertise goes. I've asked some questions, not understood the answers, and I'm kind of watching Bitcoins with interest because the concept is fascinating. And,
for those who are listening, John's kind of explained it, and maybe somebody on the line has studied it more, and if they want to chime in and share, they'd be more than happy to, but you can just press *6 to unmute yourself if you want to make a comment or have a question. But, in essence, this Bitcoin currency is representing in some form or fashion a challenge to paper currency.
Jay Peroni, certified financial planner, here with the idea of the week. This week, we'll take a look at a meat company that's raised its dividend for 47 years in a row. My all-weather portfolio strategy is designed to weather the storms that come and go as we experience both bull and bear markets. In order to achieve good returns and consistency, I look for high-quality investments with low volatility. I combine dividend-paying stocks with commodities, precious metals, currencies, and other securities that can thrive no matter what the markets are doing. My favorite investments today in this market are high-quality dividend-paying stocks. When you buy a dividend-paying stock, you should be concerned about a company's expected growth and the stability of its dividend payments. I typically look for stocks expected to perform in line with the market or better with above-average dividend yields. I also want to find companies that have a strong history of paying a dividend, and more importantly, those that have consistently raised their dividends. This requires looking at earnings trends. As a company becomes more profitable, it increases the likelihood that that company can continue raising dividends. Additionally, I look for companies in strong demand sectors that have the potential to thrive no matter what the markets are doing. Companies who offer recession-proof products around the globe should continue to thrive. With 70 to 80% of the world's population living in developing countries, emerging markets have been a growth area for many consumer staples companies, especially food. As per capita wealth has risen in these emerging economies, goods considered staples have now become universal needs and wants in these emerging markets. With the increase in global consumption, staples companies have great opportunities to increase their market volumes and accelerate their earnings growth rates. One of my favorite sectors right now is the food industry. Think about it. People eat no matter what the economy is doing, and the global population keeps on growing. And one of the most highly sought after foods is meat. Of the meat companies, my favorite is Hormel Foods, ticker symbol HRL. Hormel's brands include Spam, Jennie-O, Country Crock, Lloyd's, and Chi-Chi's. There are 4 reasons why I like Hormel. They package their products in a very convenient fashion. They've got meat party trays, pepperoni snack packages, turkey burgers, canned chili, microwavable meals. You get the point. As consumers look to eat more meals at home and save time through convenience packaging, Hormel is very well positioned. The second reason I like Hormel is they own the Skippy peanut butter brand. This allows them a lot of international opportunities. Right now, Skippy is the leader in China, where it generates over $30 million in sales. As it expands internationally, it can further develop the Hormel brands all across the globe. The third reason is they've got a vertically integrated supply chain that allows for economies of scale. This keeps new competitors away from eating into Hormel's market share. The fourth reason I like Hormel is they've got steady growth in economic booms and busts, as well as its history of increasing dividends every year for the past 47 years. It makes Hormel an attractive investment opportunity. Hormel Foods, ticker symbol HRL, is a good buy up to $42 a share. With a current dividend of about 1.6%, investors should be able to count on rising dividends for years to come, as they've raised their dividend every year since 1967. Again, it's Hormel Foods, ticker symbol HRL, a stock worth a closer look. This is Jay Peroni, Certified Financial Planner, signing off for the Idea of the Week. We'll see you again next week.
All right. Well, Jay Peroni is a CFP Certified Financial Planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a free 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
All right, where's my money? Money.
Daily bread. Follow the Money Weekly presents the Retirement Minute.
Hello, everyone. This is John Burse with this week's Retirement Minute. Today, I would like to answer a listener's question concerning whether an annuity contract or a life insurance policy is the best way to accumulate money for a grandchild. There are many factors in this decision, but first, ask yourself a few questions. What is the age of the grandchild? What is the money going to be used for? When do you want the grandchild to have access to the money? And do you want to keep ownership, or do you want the grandchild to have ownership of the money? Let me just give you a few pros and cons. If the money is going to be used for the grandchild before he or she reaches the age of 59 and a half, then an annuity contract owned by the grandchild would not make much sense, because they will pay income taxes on the interest earned in the annuity contract the year that they take receipt of the money. Also, there would be an additional 10% penalty of that interest earned imposed by the federal government if they are not yet 59 and a half because of the early distribution rules. So an annuity contract owned by the grandchild with the purpose of using the money before they are age 59 and a half would not be as lucrative after the tax ramifications are applied. Clearly, the purchase of a life insurance policy where the grandchild could take loans against the cash value income tax-free might have been a more appropriate choice. The drawback to the life insurance would be that you need to give this contract several years to grow, because there typically is not as much cash buildup inside the life insurance policy in the early years, mainly because all of the premiums you are paying do not all go towards the cash value. Some of the premiums will pay mortality costs for the life insurance, and there are administrative costs. If the grandparent does not want to give up ownership, then the grandparent grandparent should own the policy, and that brings up different tax issues. The advantages to the life insurance policy is that the grandparent could take loans against the cash buildup and then gift the cash to the grandchild with no tax ramifications. Also, if the grandparent passes away, the death benefit would be paid to the grandchild, assuming you name the grandchild as the beneficiary, income tax free. So this way the grandchild would have a greater amount of money than the cash value inside of the life insurance policy. If that money would be in the annuity contract that is owned by the grandparent, then as long as the grandparent is over age 59 and a half, the grandparent would only pay income taxes on the interest earned in the annuity in the year that they took distribution. If the grandparent is in a high income tax bracket, this could be detrimental. But the main what-if question is, what if the grandparent died early before the cash value had a chance to grow? Then quite clearly the life insurance would have been a better way to go. So you can see there are many scenarios that we need to talk about when making this decision to make sure it's right for you. So make sure your financial house is in order by contacting me at 1-888-914-9909, and I would be more than happy to review your financial situation with you.
Are you tired of getting whiplash from the stock market? Is the return of your money more important than getting a return on your money? In these difficult economic times, it's only natural to seek out wise investing counsel. Thanks to a new service called the All-Weather Portfolio Strategy, you'll get real-time access to our service, which only invests in high-quality companies with historically low volatility. Have you ever been caught in the rain without an umbrella or left the house without sunscreen on a hot and humid day? Sometimes the weather catches us by surprise. Just like the weather, the investment markets can also catch us by surprise, and sometimes without warning. There are times when the markets soar and we miss out on gains, or maybe we have too much in the market and suffer a major decline during volatile times. That's why we created the All-Weather Portfolio Strategy. The All-Weather Portfolio is suitable for cautious investors, those with a time horizon of 5 to 7 years, those who are close to or in retirement. The goal of the All-Weather Portfolio is to protect against losses in a down market while still taking advantage of the markets when they rise. With the All-Weather Portfolio service, you'll get 24 hours, 7-day-a-week real-time access to the portfolio. You receive instant buy and sell alerts directly in your email inbox. You'll also get a special 27-page report entitled An Introduction to High-Quality, Low-Volatility Investing, a $47 value. To learn more about the All-Weather Portfolio, go to wallstreetrenegade.com/all-weather. Again, that's wallstreetrenegade.com/all-weather.
All right, well, my next guest is a professor of economics at Birmingham Southern College, and he serves as a senior research fellow at the Institute for Faith, Work, and Economics. He is the author of 2 books, Understanding the Modern Culture Wars and Unmasking the Sacred Lies. His articles have appeared in the Journal of Private Enterprise, the Independent Review, Religion and Liberty, and the Freeman. His name is Dr. Paul Cleveland. Paul, thank you so much for joining me on Follow the Money Weekly Radio.
Well, thanks for having me. I'm looking forward to our discussion.
We made contact with you via our good friend and mutual friend, Barry James Dyke, who has been on the program numerous times talking about the shenanigans going on Wall Street. And he spoke very highly of you. He said that you're a voice that needs to be heard in these times. Why don't you share with our audience a little bit about who you are and how you got into the study of economics?
Okay, well, yeah, I'd be glad to. I grew up in Huntsville, Alabama, and went away to undergraduate school. I kind of got into economics by default. I enjoyed it. I thought it was fairly easy. Anyway, just if you get enough A's and on your transcript and take enough classes, they give you a degree, and that happened for me, and continued on down that line, and eventually they give you a PhD. So
just keep adding letters on the back of your name, right?
Right. While I had been raised in a Christian family, I had kind of not really wandered away from the faith so much, but I certainly wasn't living a Christian life. And really wasn't until I was in grad school at Texas A&M pursuing my PhD that my Christian faith became important to me.
Did it happen as a result of economics, your study of economics?
No, not really. It was a number of other circumstances in life at the time, and but there was a burning question for me, and that was, how am I going to be a Christian and an economist? And I thought, maybe these are mutually exclusive categories. So that was, kind of foremost on my mind. And here I was, like 2 years into getting my PhD, and I'm wondering, well, what do I do now? So I went and asked a couple of the professors who were on the faculty at A&M who I knew were Christians, and I asked them. To be honest, I wasn't at all impressed with their answers, and so that kind of set me off on an exploration of the study of economics and in what context can a Christian pursue that inquiry and have it gel together as a seamless whole. And I've been on that quest now for, almost 30 years.
Tell us what you found as you've kind of went down that path.
Well, one of the things I've found is that the mainstream of economics has been very much captured by Jeremy Bentham's utilitarianism. And what utilitarianism is, it views public policy issues as merely being determined by hedonistic calculus. That is, for any proposed law or program that a government might offer up, that what Bentham argued was that what people need to do is figure out how much happiness it's going to create, subtract out the pain that it would cause, and if it's a positive sum, then you do it. That's sort of his idea there. And now the significant problem with that is, how do you measure pleasure or pain, for that matter? Things that are measurable can be quantified, but pleasure and pain are not of that sort of thing. I mean, we know what volume is. In other words, I know what a liter is or a gallon. We know what distance is. I kind of know what an inch or a yard is compared to a meter. Kind of have an idea there. But how much is pleasure? I don't know. Bentham had a word for it. He called it a util. Now, I have no clue how much a util is, but he thought that eventually we would be able to quantify it. I think he's wrong, but we've, as a culture, been accepting this sort of utilitarianism as we pursue policy issues, and I think that is a chief source of how we've headed down this wrong path.
What's the opposing view to his ideas?
Well, economics proper actually started on a much different basis. It developed out of a natural law conception of things. In other words, that reason tells us that all people have the right to their own life, their liberty, and their property. In other words, we all assume that by understanding our own existence, that we have the right to our life. We all know we're volitional, therefore we believe we have the right to our choice. And we're material creatures that produce property in the course of living, and so we believe we have the right to that. In fact, those are all tied together, as John Locke would say, in a seamless whole. And if I'm going to assume that for myself, logic demands that I extend that to every last human being in a co-equal standing. And that's really what the founders meant when they said we take it as a self-evident truth that all men are created equal in that standing. Now, we're unequal in countless other ways, but in that sense, we're equal.
Okay, so now you have moved into the school of economics known as the Austrian school. When did that happen, and why do you champion that view of the economy?
Well, it was a process of moving in that direction. I had read during my educational years, just briefly, some of the writings of the Austrians, but it was really afterwards, as I began to think through the issues of the undergirding philosophies, and realizing that mainstream economics that I was primarily taught in grad school was of this utilitarianist sort, that I began to come to grips with that. Wait a second, that's at odds with the natural law. What happened was, as I began to explore the Austrians, I found out that the Austrians accepted more this natural law perspective, and it was undergirded by that. So it's anthropology in terms of the assessment of human nature was consistent with the Christian worldview. In other words, that all people are purposeful human actors.
Interesting, yeah. I've heard a lot at the upper levels of in the graduate schools of economics that many of these people who are in economics or heading towards economics degree are really in some ways have math envy. And so therefore, when they look at the Austrian school, which is not nearly as quantitative, I'm sure you can make it that way, but it's not nearly as quantitative as the other schools of economics, some people just frown on it simply because of that. What do you find in your world of academia when people frown on the Austrian school? What is their reason?
Well, they do frown on it because economists in the mainstream want economics to be kind of a precise science of the sort of, say, physics. But, of course, it can never be that if human actors are purposeful human actors actually making real decisions. In other words, there are principles of economics that drive action. In other words, one principle I would say is this, that my choices in life are my choices, and I always choose at the moment of choice what I value most. And so value is always subjective. It's subject to me, or your values are subject to you, then are subject, though, to change and be altered. In fact, tomorrow I might, in the same situation I face today, I might choose differently than I chose today. So economics cannot have that kind of precision that physics has, because physics is looking at principles of, gravitational pull, those sorts of things, which are not going to change. They're enduring, they're eternal in that sense. So those aren't going to be altered, and so you can pursue understanding that in a more precise, mechanical way. But human action's not mechanical.
That's really what happened in the economic crisis of 2007 through 2009, whenever the financial models, the economic models that had been foisted upon mankind and said this is how everything works, those broke down.
Right. Well, they're false to begin with. Keynesian economics, for one, is this sort of tautology. It's built upon an accounting identity. Keynes had no capital theory whatsoever. His capital theory amounted to, I refer to it as the bathtub theory of capital, that, it's only the amount of water in the tub. And, if you turn the faucet on a little faster and the rate of depreciation or the draining out of the water at the bottom, at some point the level of water in the tub's going to equal out. That's as much of a theory as there is in macroeconomics about capital. And the assumption is that capital is just the total dollars invested that matter. It's not what you got. And this is where Austrian economics has something to say. No, it matters what you get, because if, let's say, the Fed is artificially reducing interest rates, then what they're doing is they're jamming the signals of financial markets and inducing business decision makers to invest in capital that'll never pay off. But then on the other end, it's encouraging those who would be saving in the economy to practice dissaving. And so it creates what it is almost like a price control that's creating a shortage of savings in the economy. When that shortage is revealed, then you have a bust, because some of that capital just can't pay off. And so you have a retrenchment. In the latest round of this, people will use their houses as if they were piggy banks, Let me refinance at a lower interest rate, pull the money out, the supposed equity out, and go spend it. And then on the other hand, builders and whatnot are building all sorts of things. Why? Because interest rates are low and they can get cheap money.
My guest today is Dr. Paul Cleveland. He's a professor of economics at Birmingham Southern College, and he is the author of 2 books. And he is cut from the Austrian School of Economics. He's cut from that cloth, and he also is interested in the intersection between the Austrian school and Christianity. I want to get into that here in just a minute, Professor, but first, you have seen things over the years as you've been teaching in these classrooms. You've been seeing the minds full of mush come right into your door, and then you see them leave. Have you seen an increase in the interest of students in the topic of economics? Is it waning currently, or is it increasing currently? What's the trend?
I've always been fairly much blessed with good students at Birmingham Southern who have come to me. There may be a bit of an uptick in the interest of economics, especially as I'm teaching it in the last few years. I would say this, I've always attracted students who are willing to think, because what I say is so different than anything else they've ever heard. So that's been my experience in my teaching career on the campus.
So in your mind, now I'll ask you a very personal question. You don't have to answer, but do you view yourself as a Christian, as a believer?
Oh, absolutely.
How do you approach the world of economics from a biblical viewpoint using the Austrian school? Just give us a couple of examples.
Well, I think it's this. My understanding of the study of any particular subject is this, that on the one hand, God's revealed himself to us in his word or his revelation in the scriptures. And so if I study the scriptures, then I'm going to discover what God has revealed about himself and about us in the scriptures. And there are going to be certain principles that I would garner there. That would be theology. On the other hand, God's revealed himself to us in the creation, in the cosmos. And so there's things to know, and that's where philosophy or science is involved. So economics is a subject that I can go out and learn a whole lot about the world just by observing the world and about observing human action. And really, that's a lot of what economics is, and many Austrians who are very good economists have done their study just that way. It seems to me, though, in terms of a more robust picture, that there's an overlap between those two when we come to the social sciences. Because the scriptures have a great deal to say about the way people behave, about who we are in relationship to God. So the way in which I've pursued my own studies is both ways. And so in that center of that overlap, I'm quite willing to do it, sort of what might be said the secularist way, but it seems to me that a good understanding from science will never be at odds with a good theological understanding. In other words, the two should fit together like a hand in a glove, in a way, and reinforce what we might learn from either or.
The federal government has become so big, it has become so pervasive, it has become so collectivized, it has become so integrated, unfortunately. In fact, we even saw earlier this week that the Obama administration is moving now to, in conjunction with the Treasury, to make a lot of financial transaction data available to all intelligence agencies across the nation. And what happens is as these federal agencies begin to commingle themselves and they begin to work together, they simply become more powerful and they become much more difficult to protect yourself against. And you were talking earlier about the idea of John Locke and natural law and, of course, Austrian economics, which teaches something known as liberty, economic liberty. And unfortunately, we're losing that as we speak, aren't we? Talk to that a little bit and explain what the American people need to know right now as the federal government is encroaching upon their rights.
Well, I think you're exactly right. I was just in a discussion with a colleague. We've been working on a paper, and I think we're moving to a new title of Rule Makers Gone Wild.
Right.
And that sort of tendency. And it really, I think that tendency flows out of two different views of human life. There's sort of the naturalist view of human life that treats people as if they're just animals to be herded wherever you want them, and that somehow a ruler is able to dictate what people do. And then there's what I would say is the biblical view or the Mosaic view, and, you know, because Moses, we know, wrote the first 5 books of the Bible, and he starts out Genesis, and he says that God has said that we're made in his image, that men and women, every last person, bears the image of God. Now, one thing that I think most people don't understand is when Moses said that, I wrote those words down, that phrase, to bear the image of God, was a common phrase. It was used both in Egypt as well as Mesopotamia. However, it was never a phrase that was applied generally to every last person. Rather, it was reserved primarily to refer to the king or Pharaoh. Pharaoh bore the image of God, determined God's will, and imposed it on everybody else. So when Moses says, no, that's not the way it is, men and women, every one of you bears the image of God. What he's saying is every one of you is a king and a queen. Every one of you is at liberty, is free to determine God's will for your life and to carry it out in this world and go out and to take dominion in this world. And so that's a radical thought. It's radically different from what Obama or really any of the Republicans and Democrats alike have planned for us, because they want to impose it from the top down. And really, if you're going to take a biblical view, you're going to reject that and say, no, you can't do that to me. You have no right, usurping God's authority in my life, that I'm submitting to God, not to man on this one. So quite a bit different. And then, you know, if you begin to read the first 5 books of the Bible, you come to very different conclusions about what we're to do, what we're about doing. We do live in a world where personal liberty is being encroached upon rapidly. And so we need to begin to develop strategies that would insulate us from the abuses of government.
What are some of those strategies? I mean, if you were to rattle off a couple of things that you could personally do or tell people listening to our audience or listening in our audience what they could do, what are some strategies?
Well, one, my good friend Nelson Nash has taught me a personal financial strategy called the infinite banking concept, which I've employed in my own life.
Yeah, we've had Nelson on the program. He's a good friend of the program.
Well, good. I mean, this is a workable strategy that will get you out of the commercial banking system of the U.S. and allow you to begin to finance your own life. And I think the second thing that people need to do is whatever your gifts are, it's time for people to begin to think in entrepreneurial ways. I'm an economic educator. Well, I need to be an entrepreneurial economic educator and figure out how to make that into an activity where I'm really out on the forefront serving the interest of others. And if I'm doing that, then I'm going to be compensated for it, and, you know, I'll be compensated well. And then if I need financing to accomplish my business end of being an economic educator, and I'm using the infinite banking concept as my financial strategy, I can make this thing grow over the course of my life.
Very interesting.
And I think that's what other people need to be doing too. And as we do that, we make government irrelevant.
Interesting. Yeah, that's so true. And in fact, part of the story that I brought up earlier, the financial transactions being transparent to the intelligence agencies here, you know, one of the immediate calls was get out of the banking system. But how do you do that? Well, the infinite banking system, well, that's a great point. I had not connected the two dots as of the last couple of days on that topic. So very good point.
Yeah. Anyway, but that's one that I think Nelson has really been on the forefront of that. And then a couple of other good friends of mine have even written a book that make this connection between the Austrian school and infinite banking concepts, and that is Carlos Lara and Robert Murphy.
Yeah, absolutely. Absolutely. It's hard to believe you're an economics professor. I would believe that you are maybe an economist, but not working in the university boiler rooms. That's really interesting to me. Very interesting, very intriguing. I know our audience thoroughly enjoyed this interview. If our folks would like to learn more about you, they'd like to learn more about your work and just kind of get to know you a little more, how can they do so?
Well, I have a website at boundarystone.org. That's BOUNDARYSTONE.org, O-R-G.
You have some articles there and way to contact you and all that?
Articles plus books. Now I'm the author of 2 books. Well, I've co-authored a third now called Basic Economics. It was actually a book written by a mentor of mine, Clarence Carson, who passed away in 2003. But that book needed to be updated a bit. I went to his heirs and asked about that. They were thrilled that I would want to do it, and so I've got that there now. And I've since taken over his other books and have those available as well. All very well done, all done from a natural law perspective and grounded in that. You know, I think education is key. Anyone who's been to the university has gotten a miseducation. And you've got to work to correct that.
Very good point. All right, my guest today is Dr. Paul Cleveland. You can find him online at boundarystone.org. Is that correct?
That's correct.
Boundarystone.org. Thanks so much for being here, Doctor, and we'll look forward to having you back on again soon.
Oh, well, thank you.
Well, friends, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It is an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time spoken by the late Steve Jobs of Apple Computer, when he said, "Remembering that I'll be dead soon is the most important tool I've ever encountered to help me make the big choices in life. Because almost everything, all external expectations, all pride, all fear of embarrassment or failure, these things just fall away in the face of death, leaving only what is truly important." Just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTNDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.